China shocks global energy markets by halting LNG imports from the U.S. China abruptly ends $2.40 billion in U.S. LNG imports. In March 2025, China unexpectedly announced the suspension of all liquefied natural gas, LNG, imports from the United States, a move valued at $2.4 billion annually. This decision is widely seen as direct retaliation following the U.S. imposition of a 10% tariff on Chinese goods just a month earlier. As the world's largest LNG exporter in 2024, producing over 91 million tons, the U.S. suddenly lost access to its second-largest market. In response, China swiftly redirected its LNG imports to Europe, both to avoid U.S. tariffs and to expand its influence in a region urgently seeking alternatives to Russian energy supplies. Well, talk about a sudden breakup. One moment they're trading billions, the next, boom, China hits unsubscribe. What do you guys think? Should the U.S. throw in a discount coupon next time to win them back? Drop your wild guesses in the comments. Let's see who can predict China's next energy crush. Europe becomes China's new LNG destination. With the U.S. forced out of the game, Europe quickly emerged as the main destination for China's LNG shipments. Countries like Germany, the Netherlands, and Italy adapted their import strategies to benefit from more affordable Asian LNG. The European Union accelerated storage projects, expanded seaport infrastructure, and increased investments in energy transfer systems across the bloc. Amid the ongoing energy crisis triggered by the Russia-Ukraine conflict, Europe eagerly welcomed these redirected LNG flows. Meanwhile, the U.S. could only watch as its market share, partnerships, and bargaining power in Europe slipped away, a region once central to its post-pandemic and post-energy crisis strategies. Australia steps in, a new one, $50 billion LNG deal with China. While the U.S. LNG sector reeled, Australia quietly secured a $1.5 billion LNG contract with China Resources Gas, one of China's largest energy conglomerates. Under this 15-year agreement starting in 2027, Australia will supply 600,000 tons of LNG annually. Not only is Australian LNG 20% cheaper than U.S. gas, but it also reaches China 10 days faster due to geographic proximity. The contract with Woodside Energy is more than just a commercial win. It's a geopolitical statement. Australia, a long-standing U.S. ally, has now become China's leading energy partner. China's strategy for energy independence. With its massive energy needs as the world's second-largest economy and a population of 1.44 billion, China is placing LNG at the heart of its national energy strategy. Since the U.S. imposed tariffs on Chinese goods in 2019, Beijing has steadily reduced its reliance on American LNG, from nearly 20% to just 5.4% of total imports by 2024. Instead, China has secured long-term agreements with Qatar, Russia, and Central Asian countries, invested in the East Asia Gas Pipeline, set to operate in 2027, and strengthened energy cooperation with Australia across both LNG and critical minerals. These moves aim to ensure energy security and avoid overdependence on any single supplier amid escalating trade tensions. The fallout: U.S. LNG industry faces a reckoning. Before the suspension, the U.S. exported about 400,000 tons of LNG to China annually, generating $2.4 billion. Now, U.S. LNG terminals are left with unsold inventories, canceled contracts, and skyrocketing shipping costs. Meanwhile, Australia has leapfrogged the U.S., becoming China's top LNG supplier and a major player in Asian energy markets. This disruption to the billion-dollar industry risks triggering a major restructuring of the U.S. LNG sector as global energy dynamics enter a new era, one where price and geopolitics are equally decisive. Canada's energy shift, embracing China and sidestepping U.S. trade policies. China moves in as the U.S. loses ground. After the U.S. proposed a 10% tariff on Canadian oil and gas imports, China quietly moved into the heart of Canada's energy sector. Rongsheng Petrochemical, a major Chinese oil refiner with a capacity of 800,000 barrels per day, quickly opened an office in Calgary. Soon after, it secured a crude oil supply agreement with Suncor, one of Canada's energy giants. Shipments to China are set to begin in June 2024, with negotiations ongoing with other major players like Chevron, Shell, BP, and ConocoPhillips. By choosing free on-board FOB contracts, these deals allow flexible destination changes, boosting China's strategic leverage. TMX project transforms Canada's energy landscape. The game-changing moment came with the completion of the Trans Mountain Expansion, TMX project in early 2024. Stretching nearly 1,200 kilometers, the pipeline tripled Canada's export capacity from 300,000 to 890,000 barrels per day, enabling Canadian crude to reach Pacific ports directly, bypassing the U.S. for the first time. This opens direct access to China, Japan, and South Korea, whose refineries are optimized for heavy, sour crude. Previously, over 95% of Canadian oil exports were shipped to the U.S., leaving Ottawa vulnerable to Washington's policy shifts. Canada awakens, from dependent exporter to global competitor. When threatened by U.S. tariffs, Canada quickly responded with a $6.5 billion support package, of which $5 billion was allocated to help businesses access global markets. Canadian companies didn't wait. With TMX operational, Rongsheng became a strategic buyer not just of oil, but also of LNG. Canada's LNG Canada project in Kitimat, British Columbia, backed by Shell, PetroChina, and Mitsubishi, is on track for completion. LNG exports are expected to start by late 2025, opening a direct path to Asia. Canada is no longer dependent on American markets. It is now steering the global energy flow, embracing its role as a true global energy competitor. The chaos of Trump's tariff policies, economic turmoil, and global shifts. Tariff whiplash, from tough talk to unpredictable policies. Donald Trump, during his presidency and even in his later campaign rhetoric, consistently portrayed tariffs as a potent economic weapon, a surefire way to boost American industries, punish foreign competitors, and reclaim lost manufacturing jobs. He famously promised that these measures would revitalize domestic production and reduce trade deficits, framing tariffs as a patriotic duty. However, once the policies were actually implemented, targeting even close trade partners like Canada and Mexico, the stark realities of global economics quickly set in. Markets responded with alarm. U.S. stock indices suffered sharp declines, unemployment figures crept upward, and consumer spending, the backbone of the American economy, weakened considerably. Within months, whispers of an impending recession morphed into loud, unavoidable headlines dominating news cycles. The erratic, unpredictable nature of Trump's tariff strategy only amplified the damage. His on-again, off-again approach sowed deep confusion among American businesses and consumers alike. Companies found it nearly impossible to plan for the future when tariffs were imposed one day, reversed the next under pressure, and then unpredictably reinstated. This volatility led to sudden price hikes across a wide range of essentials. Food prices spiked, fuel costs rose sharply, and everyday consumer goods became noticeably more expensive, placing additional strain on average American households already grappling with stagnant wages. Satirical criticism, Jon Stewart and Josh Johnson, mock the chaos. Public frustration was captured and magnified through sharp satire. Comedians like Jon Stewart and Josh Johnson became vocal critics of the chaos, using humor to expose the absurdity of Trump's constantly shifting trade policies. They underscored how these knee-jerk decisions were often announced with grandiose fanfare, only to be quietly walked back amid public and market backlash, before being reinstated in yet another erratic move. Josh Johnson, in particular, delivered a biting observation that resonated widely. Prices are rising, but apparently it's not inflation. It's just everything getting more expensive. His quip summed up the growing sense of disillusionment across the country. Through satire, comedians highlighted a serious reality. The lack of coherent, stable policy direction was not only eroding public confidence, but also deepening economic anxiety nationwide. A losing battle, U.S. markets suffer while China rises. As the United States struggled with the repercussions of trade uncertainty, inflationary pressures, and stagnating industrial growth, China seized the moment to advance its own economic agenda. By 2024, China's MSCI index soared by an impressive 28%, reflecting robust investor confidence and economic momentum. In stark contrast, the U.S. Nasdaq suffered a decline of 10.8%, underscoring the widening gap between the two economies. China's success was no accident. Beijing adopted a disciplined approach, slashing interest rates to stimulate domestic investment, implementing stable monetary policies to reassure global markets, and attracting a wave of foreign direct investment, which skyrocketed by 88.4%. Major multinational corporations, including pharmaceutical giant AstraZeneca, expanded their operations within China, further integrating the nation into global supply chains. Moreover, China rapidly ascended in critical future-focused industries. In sectors such as artificial intelligence and electric vehicles, Chinese firms like DeepSeek AI and BYD emerged as global leaders. BYD, in particular, not only outpaced American competitors in EV sales, but also aggressively expanded its global market share. Meanwhile, U.S. industries faced rising production costs, wavering consumer demand, and manufacturing output that stubbornly refused to regain pre-tariff growth levels. Ultimately, Trump's tariff crusade, intended to restore American economic dominance, backfired spectacularly. It exposed vulnerabilities in the U.S. economy while inadvertently giving China and other nations the opportunity to strengthen their positions on the world stage. What was meant to be a strategy for American resurgence instead accelerated the shift toward a more multipolar global economic landscape. BRICS challenges the dollar, a new global financial order. BRICS expansion, a geopolitical powerhouse emerges. By the year 2023, the BRICS coalition, which originally comprised Brazil, Russia, India, China, and South Africa, underwent a historic transformation. Expanding its membership, the alliance welcomed 4 new nations: Egypt, the United Arab Emirates, UAE, Ethiopia, and Cuba. This significant enlargement has not only diversified the geopolitical influence of the bloc, but also substantially increased its economic clout. Together, the expanded BRICS group now represents an impressive 36.7% of global GDP, overtaking the G7's share of 30%. This shift signals a new balance of power in international economics, as BRICS evolves from a coalition of emerging markets into a formidable economic powerhouse with the capacity to redefine global trade dynamics. At the pivotal 2024 BRICS Summit held in Kazan, Russia took center stage by presenting a groundbreaking proposal, the prototype of a unified BRICS currency. Unlike traditional fiat currencies, this new instrument is designed as a gold-backed, blockchain-powered note, specifically created to facilitate cross-border trade among member nations. The objective is clear: to reduce, if not eventually eliminate, the overwhelming global dependence on the US dollar. By embracing both precious metal backing and cutting-edge blockchain technology, the BRICS nations are laying the groundwork for a more secure, transparent, and independent financial ecosystem. Trump's aggressive response. The U.S., under Donald Trump's leadership, reacted with unmistakable hostility. Viewing the BRICS initiative as a direct threat to America's financial supremacy, Trump publicly threatened to impose crippling tariffs of up to 150% on any BRICS member that sought to transition away from the dollar-based system. Furthermore, he warned of a total severing of trade ties with nations participating in or supporting this alternative financial order. Trump justified these extreme measures by arguing that abandoning the dollar would severely disrupt U.S. trade balances and undermine the nation's ongoing efforts to control inflation. His aggressive rhetoric reflects deep concerns within Washington about the potential erosion of the dollar's long-held status as the world's primary reserve currency. The dollar's decline in energy markets. One of the most visible arenas of this monetary shift is the global energy market. By the close of 2023, approximately 20% of worldwide oil transactions were already being settled in currencies other than the US dollar. This is an unmistakable sign of changing tides in global trade practices. Cuba's inclusion in BRICS stands out as a particularly symbolic moment. After enduring decades of US-led sanctions and economic isolation, Havana now finds itself reintegrated into a global economic framework, gaining access to BRICS development funds and favorable trade agreements, all conducted without the need for dollar settlements. This newfound economic freedom marks a turning point not just for Cuba, but for other nations seeking alternatives to dollar dominance. Conclusion: a multipolar future is emerging. Global power dynamics are shifting. China is outmaneuvering the U.S. in energy markets. Canada is becoming a formidable global energy player, and BRICS is forging a path toward financial independence from the dollar. As Washington clings to unstable tariff policies and confronts internal economic headwinds, the rest of the world is building new alliances and frameworks for trade, energy, and finance. The question remains, are we witnessing a permanent realignment of global power, or merely a temporary fluctuation? Either way, the next chapter of this global rivalry is already being written.